explore the enduring principles of William Delbert Gann, who held that the passage of time, rather than price movement, is the primary force behind financial market trends. Gann's most significant insight, the very foundation of his renowned forecasting prowess, was his realization that time, not price, is the ultimate determinant of market direction. He concluded that markets do not behave erratically, but are instead directed by unchangeable cyclical principles. He proved that by comprehending these time cycles, one could anticipate future turning points with a level of accuracy that challenged conventional wisdom. For him, the market was not a random game of chance, but a divine mathematical system, a symphony in which each element performed its role in accordance with a precise temporal framework. This video is a thorough examination of that principle. We will investigate the philosophy and the mechanics of the time cycles that William Delbert Gann employed to foresee the future. This is not about a singular secret formula, but rather a fundamental change in viewpoint, from merely observing price to understanding the market's own internal rhythm. Before we delve deeper, a moment to subscribe and share a brief comment, even a single word, would be appreciated. This simple act aids the algorithm in presenting this video to a wider audience and confirms that these in-depth analyses are valuable. The whole of William Delbert Gann's philosophy stems from one central powerful belief, which he often referenced from Scripture. The thing that hath been, it is that which shall be, and that which is done is that which shall be done. And there is no new thing under the sun. To him, this was not an abstract piece of wisdom, but a concrete mathematical law that served as the key to deciphering the markets. He perceived financial markets as a pure manifestation of human nature. And since human nature itself is unchanging, the patterns it generates must also be constant. The emotions of avarice, fear, optimism, and hopelessness are the same now as they were a century ago. These perpetual emotions, when displayed by the masses in the financial arena, forged distinct, recurring, and consequently predictable cycles of behavior. This conviction was the driving force behind his legendary discipline. He maintained that no individual could hope to achieve success without first examining the past. While his peers were pursuing tips and hearsay on the trading floor, William Delbert Gann was in his office, frequently working deep into the night, encircled by historical data. He gathered charts of stocks and commodities that went back for decades, and in some instances more than 100 years. He was a historian of financial data, sifting through the records of the past to find the immutable laws hidden within. He wasn't just observing old price formations. He was undertaking a scientific inquiry into time itself. He calculated the precise number of days, weeks, and months between significant market tops and bottoms. He chronicled the duration of bull and bear markets, the length of secondary rallies, and the span of corrective pullbacks. Through this comprehensive empirical study, he arrived at his core discovery. Market fluctuations are not arbitrary. They are governed by what he called the law of vibration. He was convinced that every stock, every commodity, and the market in its entirety had its own distinct vibratory frequency. This frequency, once identified, could be utilized to map its future trajectory. The key to finding this frequency was the study of its history. By pinpointing the prevailing time cycles that had governed a market previously, he could extend them forward to predict its future turning points. He wrote, "The more you study past records, the surer you are to be able to detect the trend of the future." This is why his primary instruction to any pupil was to gain knowledge. Without the diligent effort of preparation and the thorough study of history, any venture into speculation was, in his opinion, merely a blind bet destined for failure. His insights were not granted to him in a moment of mystical revelation. They were earned through decades of painstaking scientific research into the cyclical properties of time. The greatest challenge in speculation is not finding profit, but preserving capital. For timeless guidance, we turn to the foundational work of Thomas William Delbert Gann. His 1923 text, Truth of the Stock Tape. This essential volume lays out 24 immutable rules for market success, emphasizing that the mastery of money management and correctly determining the major trend are the keys to longevity. Find the link to this indispensable wisdom in the description below. In the analytical system of William Delbert Gann, time and price were not treated as equals. He asserted with absolute certainty that time is the most critical element in forecasting market movements. This is arguably his most significant deviation from traditional technical analysis, and it is the crux of understanding his forecasting genius. He had found through his historical analysis that time possessed the power to outweigh price. This implied that when a major, predetermined time cycle had concluded, the market was forced to reverse its trend, often irrespective of the current news or the seeming strength or weakness of the price action. To comprehend this revolutionary idea, one must see the market as William Delbert Gann did, as an object in perpetual motion, regulated by cycles of energy. A bull or bear market is akin to a wave of energy that grows, crests, and then unavoidably subsides over a defined span of time. Once that period is over, the energy for that trend is depleted. The market is then in a state of balance, or what he termed being overbalanced in time, making it ripe for a reversal. The smallest amount of pressure can then initiate a new wave of energy moving in the opposite direction. He wrote, "My experience has taught me that nothing can stop the trend as long as the time cycle shows uptrend. Nothing can stop its decline as long as the time cycle shows down. This principle clarifies a phenomenon that puzzles many traders: the market's tendency to rally on negative news or fall on positive news. From Gann's viewpoint, there is no contradiction. If a bull market's primary time cycle has finished, no amount of strong earnings, positive economic data, or bullish headlines can stop the new bear trend from starting. The internal force of the concluded time cycle is stronger than any external news. The good news merely creates one last chance for insiders to sell their shares to an enthusiastic public just before the trend shifts. Conversely, if a prolonged bear market has reached its temporal conclusion, a flood of bad news may not drive prices lower and could even signal the final bottom as the last of the panicked sellers offload their positions to informed buyers who recognize that the time for a new bull market has come. This is exactly how William Delbert Gann was able to produce his well-known annual forecasts, frequently predicting the precise dates of major turning points months or even years ahead of time. He was not predicting the news. He was predicting the completion of the major historical time cycles that he knew would control the market's primary trend. This insight led him to one of his most vital practical guidelines. Never purchase a stock just because its price appears low, and never sell a stock just because its price seems high. A stock that seems perilously overbought can keep rising for many more months if its dominant time cycle has not yet concluded. And a stock that looks like a bargain can continue to fall relentlessly if it is still caught in a bearish time cycle. The ultimate decision to take action, he instructed, must be delayed until the time is correct. It is only when a market nears a crucial temporal juncture that a trader should begin seeking confirmation from price and volume. Time is the master regulator, and the prudent trader learns to operate in harmony with its cadence. Having established the core philosophy that time is the supreme element governing market activity, we now shift from the theoretical to the practical. A principle is of little value without a method for its use. William Delbert Gann did not rely on ambiguous ideas. He was a master of mechanics who developed a precise, organized set of tools for measuring and forecasting the market's temporal beat. He provided a clear guide to the specific time cycles he had uncovered through decades of relentless research. This is the functional core of his approach. We will now methodically examine the calendar and the cycles that William Delbert Gann utilized, beginning with the shortest-term vibrations and progressing to the great master cycles that dictate bull and bear markets over numerous years. This is not a theoretical discourse. It is a practical manual for the tools he used to call market turns with such striking accuracy. William Delbert Gann's analysis started with the smaller yet critically important time frames that govern the minor and intermediate swings of the market. He knew that major trends were constructed from a series of smaller harmonic waves, and by mastering the timing of these waves, a trader could position themselves for the larger movement. His research uncovered a distinct hierarchy of time cycles for reactions and rallies. The briefest of these important periods were moves lasting 7 to 12 days. He observed that after a market advanced or declined for this length of time, it was frequently due for a minor reversal or a period of consolidation. This gave the active trader a time window to be on high alert. If a stock had rallied for 10 straight days from a low, the Gann trader understood it was entering a high probability area for a pullback and would exercise caution before opening new long positions. If a move continued past this initial time frame, the next key time cycle to monitor was 18 to 21 days. This period, roughly 3 weeks, was among his most dependable signals for the end of a standard corrective reaction within a strong bull market, or a secondary rally within a bear market. He noted, "Buy on a 3 weeks reaction or decline in a bull market when the main trend is up, as this is the average reaction in a strong bull market." This was a fundamental part of his practical methodology. It offered a clear, time-based rule for entering in alignment with the primary trend. The move was then anticipated to continue further, with the next significant cycle cluster being 28 to 31 days, or about 1 month. A rally or decline that lasted for an entire month was a major event and frequently indicated a more substantial turning point than the shorter cycles. As the length of a move grew, so did the significance of the time cycle. The next major periods William Delbert Gann identified were 42 to 49 days, approximately 6 to 7 weeks, and 57 to 65 days. The 49-day cycle, being the square of 7, had special importance in his work. A correction lasting 49 days was a deep and significant test of the primary trend. The 60 to 65-day period was even more crucial. He described it as about the greatest average time that a bear market rallies or a bull market reacts. Consequently, if a primary bull market had been correcting for nearly 2 months, he knew it was nearing a major time support area where a reversal was highly likely. Finally, he gave great weight to the 90-day cycle, or roughly 3 months, seeing it as a quarter of the year and a major temporal division. A 90-day advance or decline often signified the end of a major intermediate trend, preparing the ground for a significant counter-trend move. By memorizing these key durations from 7 days to 90 days, the Gann trader was armed with a temporal map, enabling him to gauge the maturity of any given swing and foresee its probable endpoint. Beyond these repeating numerical cycles, William Delbert Gann found that the market was subject to a strong seasonal effect. Through his study of over a century of data, he discovered that particular months, and even specific date clusters within those months, had a remarkably high likelihood of producing a trend change. This was not astrology, but a scientific observation of recurring patterns, likely connected to the rhythms of commerce, agriculture, dividend schedules, and mass psychology. In his later writings, he published this financial calendar as a resource for his students. He pinpointed the periods of January 7th to 10th and 19th to 24th as critical junctures at the year's start for trend changes that could persist for several months. February, particularly the 3rd to 10th and 20th to 25th, was of similar consequence. He noted that major turns frequently happened around the spring equinox from March 20th to 27th. The month of May, especially May 21st to 28th, was highlighted as a time for major tops and bottoms, equal in importance to January and February. July, as the year's midpoint, was another pivotal month for major reversals, second only to January in its tendency to produce changes in the primary trend. However, based on his exhaustive analysis of historical highs, William Delbert Gann determined that September was the single most crucial month to watch for the peak of a major bull market. He wrote, "These periods are the most important of any in the year, especially for tops or final highs in a bull market, as more highs have occurred in September than any other month. He recommended watching the dates from September 3rd to 10th and 21st to 28th with extreme care after a long advance. Conversely, his study of historical lows showed that the largest number of bear markets concluded in the month of November, with July being the second most common month for major bottoms. By understanding this seasonal calendar, the Gann trader was alerted in advance to the specific times of year when the market was most vulnerable to a major shift in its primary direction. The ultimate and most powerful of William Delbert Gann's time cycle tools was the concept of anniversary dates. This was a cornerstone of his long-range forecasting. Through his historical research, he made a profound discovery. The market possesses a long-term memory. The exact dates of major historical highs and lows, such as the 1929 top or the 1932 bottom, were not forgotten by the market. Instead, they became powerful vibratory points that would often trigger a change in trend on or near their anniversary in subsequent years. This principle applied not only to one-year anniversaries, but also to major cycles of 2, 3, 4, 5, 7, and 10 years or more from a significant top or bottom. In 45 Years in Wall Street, he provides a detailed record proving the value of this rule. He identified the September 3rd, 1929 high and the July 8th, 1932 low as two of the most important anniversary dates to monitor every year for a trend change. He then showed how these dates consistently marked turning points in the years that followed. For instance, the high of the first major rally after the 1932 low happened on September 8, 1932. The high for the entire year in 1933 took place on July 18th, just 10 days after the anniversary of the 1932 low. The high of the secondary rally in 1933 occurred on September 18th, just after the anniversary of the 1929 high. This pattern recurred with astonishing regularity. The practical use of this secret is direct, but demands thorough preparation. The Gann trader must compile a calendar of all major and intermediate tops and bottoms for the market or stock he is analyzing. As these anniversary dates draw near, he knows the market is entering a time window of high vibratory energy where the probability of a reversal is extremely elevated. This is not a signal for blind action. It is a powerful alert that tells him when to pay the closest possible attention to his charts and other rules, to watch for the market's confirmation of a turn. This concept of anniversary dates was one of the keys to his legendary long-range forecasts. It allowed him to project critical turning points months and even years into the future, transforming forecasting from a game of chance into a science of cyclical repetition. To know the cycles of time is to have a map of the market's future, a temporal guide to when and where major turning points are likely to happen. But a map, regardless of its accuracy, is worthless without the skill to interpret the terrain directly before you. William Delbert Gann was not a passive forecaster who simply executed trades based on a calendar date. He was a master tactician who knew that his time forecasts, however potent, needed a final, clear confirmation from the market itself. He never based a decision on a single factor. His greatest secret was not just the discovery of time cycles, but the integration of these cycles with his equally strict rules of price and chart analysis. It is this combination, this convergence of evidence from the market's three primary dimensions, that lifts his methodology from mere theory to a complete and functional trading strategy. The first and most vital layer of this integration is the union of time with price. While time indicates when to anticipate a trend change, price indicates where the major conflicts between supply and demand will occur. William Delbert Gann found that market movements are not haphazard, but are governed by a precise mathematical harmony. He discovered that prices rise and fall in proportional waves, and that the most powerful zones of support and resistance could be calculated as simple percentages of past price ranges. Of all these, he stated the most important resistance level is 50% of any high or low price. This halfway mark, whether it be 50% of an all-time high or 50% of the range between a major top and bottom, served as a natural center of gravity for the market. Other critical percentages he employed were 25%, 75%, and the divisions of 1-3 and 2-3. The Gann methodology achieves its maximum predictive capability when a major time cycle culminates at one of these pre-calculated major price levels. Consider the final top of the Great Bull Market in 1937. The Dow Jones Industrial Average hit a high of 195.59 on March 10th. A Gann analyst would have instantly recognized this price level as being of immense importance. It was just above the 50% point of the 1929 all-time high of 386.10, which calculates to approximately 193.05. This was a massive long-term price resistance zone. Now, the analyst consults his time analysis. The Great Bull Market started from the extreme low on July 8, 1932. The time from that low to the high in March 1937 was 56 months. This was the moment of convergence he had been anticipating. A major time cycle was reaching maturity at a critical long-term price resistance level. This dual signal provided an extremely high probability that a major top was forming. It was not a guess. It was a calculated intersection of the market's two most powerful forces. The patient trader, having identified this window, would not get swept up in the bullish frenzy of the final rally. Instead, he would be preparing to close his long positions and watch for the market's final confirmation of the turn. That final confirmation is the third leg of the tripod, the signal from the price charts. The time cycle gives the alert, telling the trader when to be watchful. The price level gives the location, telling him where to expect the fight. But the actual trigger to act, the signal that the fight has been won or lost, comes from the price action itself, as shown on his charts. William Delbert Gann taught his students to wait for the market to prove that the trend had truly shifted. His main tools for this confirmation were the 3-day and 9-point swing charts. Let us continue our 1937 example. As the market neared the 195.5 level in the major time window of early 1937, the Gann trader would be observing his swing charts with maximum concentration. At that moment, the trend on both charts was still clearly up, marked by a distinct pattern of higher tops and higher bottoms. To sell at this juncture would be to act on speculation, a breach of his rules. He must wait for the market itself to provide the signal. After the final high on March 10th, the market started to fall. Soon it had a decline of 3 consecutive days with lower lows and lower highs, breaking the last minor bottom on the 3-day swing chart. This was the first warning, the initial sign that the upward momentum was faltering. As the decline persisted, it eventually broke the last significant bottom on the more important 9-point swing chart. This was the conclusive validation. The time was complete. The price resistance had held. And now the chart had confirmed the change in the primary trend. It was at this moment, and not a second before, that the professional trader would act with conviction, closing all long positions and opening short positions for the new bear market. This methodical 3-step process, time, price, and confirmation, is the very core of the Gann trading strategy. It is a system built to remove guesswork, control emotion, and align the trader with the market's true underlying structure. In conclusion, the secrets of the time cycles used by William Delbert Gann are not found in a single magic number or a cryptic formula. They are found in a complete, holistic, and scientific methodology for analyzing and forecasting the markets. His great discovery was that time is the primary organizing principle, the very framework upon which all market movements are constructed. But his genius lay in making this discovery functional by integrating it at every stage with his rigorous analysis of price and confirmation. He taught that the market is a trinity of forces, time, price, and volume, and that the highest probability trading opportunities arise only when all three are in agreement. The journey to mastering this approach is not simple. It is not a quick path to wealth. It is a path that requires what William Delbert Gann himself gave: years of diligent study, relentless preparation, and an unwavering discipline to adhere to a set of time-tested rules. He saw speculation not as a game of luck, but as a profession as serious and demanding as that of a doctor or an engineer. The trader must do the work. He must build the charts, study the history, and learn the rules that govern market behavior. But for those willing to undertake this study, the rewards are profound. By learning to read the market's internal clock, by understanding the harmony between time and price, and by waiting patiently for the market's own confirmation, the trader can move beyond the influence of hope and fear. He can begin to navigate the markets not as a gambler thrown about by random events, but as a skilled mariner who understands the tides, the currents, and the stars. This is the ultimate secret of William Delbert Gann, that through knowledge and discipline, any serious student can transform speculation into a profitable profession.